Let's get to it. Welcome, friends. This is episode 5 of the Rob Breakenridge Show. Thank you so much for joining us. Don't forget, you can find us at robbreakenridge.ca, which is where the podcast is hosted. You can find us now on Apple Podcasts, so listen and subscribe there, as well as on Spotify, on Amazon Music. Don't forget our YouTube channel as well, Rob Breakenridge Show. But, of course, the website, robbreakenridge.ca. Listen, we got a lot to get to on this episode of the program. We'll certainly talk more about the First Minister's meeting, where things are going in terms of Ottawa's agenda, the relationship between Ottawa and the provinces, Alberta in particular. Want to let you know who we got coming up for interviews on this episode of the podcast. We will hear from economist Trevor Tombe coming up momentarily. Very timely new analysis from Professor Tombe for the Montreal Economic Institute on interprovincial trade barriers. Something the premiers, the prime minister are all talking about, and just why it's so difficult and expensive to do business in Canada. And this analysis looking at how much the economy would benefit, like to the tune of tens of billions of dollars. So substantial amounts of money if we could just simply remove many of these trade barriers that limit or inhibit trade within Canada. So we'll talk about that. Also, as it pertains to the relationship between Alberta and Ottawa, interesting new study from the Macdonald-Laurier Institute looking at how Ottawa trampling on provincial jurisdiction is a big cause of Western alienation, a lot of the frustration in the West. So where have we seen that, and how do we bring back some balance to that relationship? We're going to hear today from Sonya Savage, who's the co-author of that report. Also, as you may recall, was Alberta's former Minister of Energy, also of the Environment. So we'll hear from Sonya Savage today. And coming up later on, we'll hear from commodity analyst Rory Johnston. He's with commoditycontext.com. Some great insight on what's happening on oil markets. And I want to talk about what's going on with the price of oil, what it means for Alberta's bottom line, but also what it means for production in Alberta, investment in Alberta. So we'll talk about oil prices, oil production, oil pipelines, all of that coming up on this episode of the Rob Breakenridge Show. A conversation later on today with commodity analyst Rory Johnston. But first, let's get to the latest news on what was billed as a very consequential First Minister's meeting, the Prime Minister, the Premiers gathering in Saskatoon on Monday, with the backdrop, of course, of renewed tariff threats from U.S. President Donald Trump, talking about raising steel and aluminum tariffs all the way up to 50%, which could be pretty devastating to Canada, and just reiterating the urgency of taking steps to bolster Canada's economy. One of those areas would be to reduce internal trade barriers and allow trade to flow more freely within Canada. We are seeing some progress on that front. Of course, Nova Scotia, some other provinces have begun the legislative process of reducing their own trade barriers going into this First Minister's meeting just on the eve of this meeting Sunday. Announcement that Ontario would sign deals or memorandums of understanding with Alberta, as well as Saskatchewan, Prince Edward Island. So we're seeing some progress on that. Also, following this minister's meeting, which again, and after the fact, and if you listen to the press conference, you had all the premiers talking about what a positive meeting it was, very upbeat and unified tone. And I mean, that's a positive in and of itself. But you have the Prime Minister in his comments talking about, the need for urgent action. We're going to build big, build bold, build now, was what the Prime Minister said. The idea of identifying projects that can be in the national interest and accelerating the process to making those happen. He says he wants us to be an energy superpower, to have the strongest economy in the G7. So this is all very aspirational. What's that going to mean in practice? And of course, Alberta is making the case that if we really want all of that to work, we really want projects that are going to bolster the Canadian economy and projects that would be in the national interest, look no further than new pipelines. So is there some consensus on that? So a couple of segments here from the press conference I wanted to share with you with some comments from both the Prime Minister and Alberta's Premier. First and foremost, on this question of would pipelines be considered as projects that could be in the national interest, that could be accelerated? Here's a response from both Prime Minister Mark Carney and Alberta Premier Danielle Smith.
Is the federal government at this point considering pipelines a project of national significance, and will you be sidestepping certain environmental requirements outlined in Bill C-69 to fast-track such a project?
Well, the first thing to say is, and let me be a bit more specific, if I could, because and I will defer to the premiers to add, but the Western premiers and the premiers of the territories met and supported an approach. The Western Corridor, the Western and Arctic Corridor, effectively a corridor between port to port to port, from Pacific Northwest to James Bay to Grays Bay Point, and within that are opportunities in energy, critical minerals, and well beyond. And specifically within energy, opportunities, yes, for an oil pipeline to get to Tidewater. Now, within the broader context of national interest, the interest is in, as mentioned in the press release, decarbonized barrels. So working alongside forms of decarbonization for those barrels. That is absolutely in our interest. It provides diversification of trade partners. It provides the development of new industries. It provides economic activity across the west and into the north. So yes, there's real potential there. We took up a good deal of our time in discussions and potential to move forward on that. And if further developed, the federal government will look to advance it.
So if I'm understanding correctly, Prime Minister, you are saying that you would fast-track a project involving decarbonized oil through pipelines, decarbonized energy. And is that something that, Premier Smith, that you agree with, or do you feel that we need to get the bitumen out of the ground now as soon as possible?
Well, let's call it the grand bargain, that we know that there is a group of oil sands companies that have been advocating for some time for what they call the Pathways Project that would decarbonize the production of their bitumen through the use of carbon capture, utilization, and storage, ultimately using hydroelectric or small modular nuclear to decarbonize, and then direct air capture for the last mile. I think the point I was making to the Prime Minister and my colleagues is that there's lots of ways to decarbonize, but the Pathways Project is an expensive project. It would cost anywhere from $10 to $20 billion to get built. And to make the economic case for that, having more egress with more barrels to be sold to Asia is the way to pay for it. If we had a 1 million barrel a day pipeline going to the northwest BC coast, that would generate about $20 billion a year in revenues. And so that seems like a pretty good value proposition if both of those projects can proceed at once.
Okay, so that was interesting, because I think you got the Prime Minister and the Premier almost on the same page in a way, at least when it comes to these projects. There's the other point, though, in all of this. It's one thing to talk about, we want a pipeline here or a pipeline there. This isn't something that the government would typically take the lead on, right? The way this would work is that a private company would propose to make such an investment, identify a project they think would make sense, and go to the government for approval. So there was a question put to both the Prime Minister and Alberta's Premier with regard to a pipeline project that could be identified or deemed to be in the national interest, and we could see some quick progress on it. Don't we first need a private company to step forward and make such a proposal?
There is an ability to build that energy infrastructure, that oil pipeline. I'm going to refer to my earlier answer and to Premier Smith's answer moments ago about a grand bargain. Decarbonizing the barrels, various ways to do that. I agree with her, and so the opportunity is there. The market is there in Asia. It is within. Last point. It is within a bigger framework that the Western premiers and the territorial premiers have come up with, which is the Western and Arctic corridor. So it's much more than that. And if I can. Just finish with this is the point for the country. Our ambitions must be bigger and broader, and what we heard today, what we discussed today, was entirely consistent with that. Big, broad ambitions consistent with having the strongest economy in the G7 and being an energy superpower. Thank you.
We'll have time. And what I heard from the Prime Minister is that, it's up to us to find the proponent, I think. I think if there's some certainty that a process is going to be successful in a reasonable period of time, a 2-year window, I think that there will be a proponent that will step forward. My view would be that we'll have failed at the assignment if government has to build another pipeline. That will demonstrate to us that we didn't create the conditions for private investment to come to the table. So I'm encouraged that the Prime Minister is prepared to do a two-track process. Let's identify a project and a window and work towards identifying the ways, some of the barriers that have been in the way of the current regulatory process, at the same time as working on fixing the regulatory process so that it makes future projects easier to approve. I think the reason we have to have a fast track is because we know that there are barriers. And so if we can kickstart it and have a dual track, I think that we may be able to achieve the outcome. We'll know in a couple of months' time, hopefully, whether this new approach is going to work. But I think it's worth giving it a try.
Okay, so some interesting comments there from the Prime Minister and Alberta's Premier. I think in a lot of ways sounding almost in unison or something close to an agreement. Very much a far cry, I guess, from how things were with Mark Carney's predecessor. But look, Danielle Smith has laid out a lot of conditions and expectations and things that she wants to see happen. So how hard and fast is she going to be when it comes to some of those targets? And what are we expecting to see? What's realistic when it comes to what we can expect to see in the coming weeks and months here? So, yes, this was billed as a big and important, a consequential First Minister's meeting. Yes, everybody seems to be in agreement. Yes, there's a lot of talk about taking big swings here. Build big, build bold, build now, this kind of talk, and energy superpower, strongest economy in the G7. But I think we still need to see what that's all going to mean in practice. Now, this could be a jumping off point to some of that, or at least certainly I think given everything that we're dealing with at the moment, we should certainly hope so. And I would add too, on the political side of things, what's the downside to following through on this? I think Canadians want and expect this. I think there's a consensus that we need to move in this direction. Sure, there's going to be some disagreement around specifics, but I think Canadians would just be really disappointed if nothing comes of all of this. If we just fall back on the status quo or fall back in the old patterns of this is too hard or we got to study it too much or just that typical inaction that I think unfortunately has come to characterize the way Canada deals with these big issues. So I think there's a real political upside to actually showing that we can do this. And if there's a willingness, a consensus, I don't see why this can't happen. But there is a lot of work to do. All right, when we come back, we're going to take a closer look at the issue of interprovincial trade and why it's so important for provinces and the federal government to reduce barriers to internal trade. There's a new analysis out from the Montreal Economic Institute that quantifies just how big a boost there would be to Canada's GDP if we could get our act together and move on this. So we'll explore that in detail coming up shortly here. My name is Rob Breakenridge. We're back with more right after this. Welcome back. This is the Rob Breakenridge Show. Thanks for joining us on this episode of the podcast. So as we've been discussing, it is encouraging to see all this talk amongst the first ministers, amongst the provinces and the federal government, of course, of removing internal trade barriers. This is an obvious and simple thing that Canada can do right now to really unleash our economy at a time when we're really kind of questioning our relationship with our biggest trading partner. But it shouldn't be easier to trade north-south than it is east-west in this country. So, yeah, look, we've talked a lot about it over the years, but unfortunately we haven't seen a lot of movement. This time, though, could be different. So we've seen some of these MOUs, memorandums of understanding between provinces, but some provinces are really taking the lead, and maybe one in particular has been Nova Scotia. And legislation recently tabled in Nova Scotia that would go a long way in reducing a lot of these internal trade barriers. Now, as it happens, there's a new analysis out from the Montreal Economic Institute that takes a closer look at what the impact would be if other provinces were to follow Nova Scotia's lead, or even to have more bilateral agreements between provinces. The more we can do to reduce these trade barriers, the better off Canada's economy is going to be. And it's pretty substantial. The gains we could realize, this report concludes that removing these trade barriers, especially if we involve Ontario and Quebec, we're talking about tens of billions of dollars that we could add to the Canadian economy. So you can read this report for yourself. It's up at iedm.org. Trevor Tombe is a professor of economics at the University of Calgary. He's a senior fellow with the Montreal Economic Institute, and he is author of this analysis. Trevor Tombe, so great to have you with us here. Welcome to the program.
Yeah, great to be on. Thanks for having me.
So when we talk about these internal trade barriers, and it means a lot of different things, but more or less, what is it we're talking about here, first of all?
Well, we're certainly not talking about tariffs like what you see between countries, where it's an explicit tax on a good that crosses a border. Within Canada, what we're talking about are just differences in the rules, regulations, standards, certifications, and so on that vary from one province to the next. And so if you're a business that operates across borders or seeks to buy or sell across those same borders, you have to comply sometimes with multiple sets of rules and regulations, or sometimes your credential as a service provider, or as an individual, might not be recognized in another jurisdiction. So these are, think of hundreds of thousands of regulatory barriers, each very small in their own right, but they add up to tremendous costs of doing business across Canada.
Are these inherently protectionist in nature? Is it just simply a byproduct of provinces having jurisdiction and we just end up with a patchwork of different rules?
Yeah, great question. So Canada is an extremely decentralized country, one of the most decentralized on earth, and provinces have jurisdiction over many areas and many spheres that are quite relevant for economic transaction, property and civil rights in particular. So they regulate professions, they regulate health and safety in work sites and so on in most sectors in the economy. And so the rules being different from one province to the next is not because they were seeking to be protectionist. It's just because the rules are developed with different procedures, different governments, maybe different considerations, and at different points in time are naturally going to vary a little bit. And even if they don't vary all that much, you may still need to go through an inspection or recertification of your credential. So, if you bring a vehicle from another province into Alberta, even if it's brand spanking new, you need to get an inspection before you're allowed to drive it on the road. So a couple $100 for no reason other than that's just a part of the regulatory system that provinces have. And the drag on trade is kind of a consequence, a really costly consequence, but not an explicit goal.
Right. As you say, there's a cost regardless of the intent. How do we go about quantifying what the impact of these regulations and barriers are? And I guess by extension, what it would do to reduce and eliminate them?
Yeah, great question. So luckily, there's decades of economic research that looks at international trade and the consequences of trade costs in that sphere. Every time we sign a free trade agreement, there are estimates from governments, from analysts and think tanks and researchers like myself trying to quantify how big those gains are. So we can simply take the tools that exist and are very well developed for international trade and apply that to internal trade within Canada. And we can do that to both measure how big these non-tariff barriers are and think about quantifying the gains to Canada's economy and productivity if they were to be removed. And we do find that the trade costs are pretty meaningful. On goods, a couple percentage points, maybe as high as 7 to 8% or so, depending on the paper and the method. But for services, well into the double digits in terms of what the effective cost is, as like an implicit tax, if you will, of transacting across provincial borders. And if these were to be eliminated, then my work here with the MEI and other papers and other analysts as well, suggesting the gains could easily be on the order of $200 billion or so. Again, if they're fully removed, and that's unlikely a realistic prospect in the short term at least, but the gains are considerable.
Yeah, we mentioned Nova Scotia. I mean, Nova Scotia, as you say, is not fully removing all of these barriers, but it's a pretty big step in this direction. So talk a bit about what it is Nova Scotia is proposing to do here.
Sure. So typically, or at least if we look back in previous years, Canadian governments have sought to try and overcome these differences by harmonizing regulations. And that's great, but it's extremely slow where you pick up one set of regulations and then harmonize across the country. And so what Nova Scotia rolled out earlier this year in February was effectively a bill that says, you know what, we're not going to harmonize our rules with other jurisdictions, but we will recognize as automatically compliant with Nova Scotia rules compliance with some other province's rules. so long as that other province reciprocates. So Nova Scotia and Ontario have a recent agreement now, and we'll see what the follow through is. But the verbal commitment in writing in this memorandum is that they will defer to each other's rules. So you might have a product that is safe for sale and consumption in Ontario that not technically complies with Nova Scotia's rules, but it would be allowed for sale in Nova Scotia, and vice versa. And importantly, if they can extend that to professional credentials, having a lawyer being able to provide legal services to a client in another jurisdiction without having to go through the certification in the other jurisdiction, then the gains could be really large. And this is a new approach that Nova Scotia's rolled out. Mutual recognition with a reciprocal partner, kind of with these deals pair by pair. And so New Brunswick has now rolled out a couple, Manitoba and Ontario most recently. And just yesterday, even Quebec has brought forward a bill to effectively do just that. Now, right now, it's all kind of verbal commitments. The follow through will matter quite a bit, but this mutual recognition of rules means that the differences will still be there. They just won't matter anymore because the business only needs to comply with one, and then it's automatically permissible in the other province.
Yeah. Well, yeah, and sometimes it just takes one to kind of get the ball rolling, and now we see other provinces follow suit. Having Quebec join in would be pretty significant, and that's something specific that this report looks at, the economic impact of having Quebec take this step, or even, to have the two biggest provinces in some kind of a bilateral agreement. That would have a huge spin-off effect.
That's right. So what we do in the report is to say, well, what Nova Scotia's done is really potentially game changing here by having a partner reciprocating with each other and deferring to each other's rules. Those gains could be quite large. So for Nova Scotia and Ontario, we estimate the gains from that alone would be a little over $4 billion per year. And that comes from increased productivity in the two economies, because with freer trade, you can have more productive firms scaling up because they're serving a larger market than they otherwise would. So with Quebec, let's imagine Quebec and Ontario can do something with each other. The two biggest economies, the gains there, we estimate exceed $32 billion. Now, let's move west. Alberta, BC, also two very large economies. If these two economies could reach a deal like what Nova Scotia and Ontario have, then the gains could be on the order, we estimate, of about $26 billion per year. And that's just these two provinces. And so imagine all of the provinces start to roll out these agreements with each other and recognize each other's rules and regulations. That's when the gains really start to mount.
Yeah, and right now I think there's some urgency in finding these kinds of initiatives that can really bolster the Canadian economy. This seems like the kind of approach where there would be almost immediate dividends. Do we see those results happen fairly quickly when provinces take these steps?
We might. Now, what we're seeing right now is just these memorandums of understanding or the bills passed through legislatures to kind of empower governments to sign these agreements and change some rules and regulations, but we haven't seen enough follow through just yet in order to, really quantify what the gains might actually be beyond just what we're estimating in the context of a model and a simulation of Canada's economy. Hopefully, that's something that we see in the coming months. Like, the momentum is really significant right now. And if about 60% of trade between provinces is in services, and the big barrier there is professional credential recognition. And if we have governments
Ottawa's
rolling,
role here. I know the Prime Minister has talked about removing federal barriers, even talked about Canada Day as kind of a target date. So where do federal rules and regulations fit into all of this?
so the federal government, it doesn't actually contribute as much as many might suspect to these interprovincial barriers. It is really just about provinces having different rules and regulations, and that's up to them to recognize each other. Now, some sectors are federally regulated, no question. So think about rail transport, air transport. There's also federal trucking regulations. So we could see the federal government deferring to provinces. So instead of regulating interprovincial trucking, they would just defer to trucking regulations at the province level. So we haven't seen that announcement yet. We might see that next week after the First Minister's meeting. But what Ottawa can do is help keep that momentum going, signal bold action by taking big leaps in areas that it does have control over. But most of the big gains, that's up to provinces.
Let's hope to see some momentum on it this week. Much more is mentioned, iedm.org. It's a Montreal Economic Institute. Trevor Tombe, appreciate your insight on all of this. Thank you for making some time for us here.
My pleasure. Thank you.
Once again, that is Trevor Tombe, Professor of Economics, University of Calgary, Senior Fellow at the Montreal Economic Institute, iedm.org, to read his report. Real good overview of the impact of removing trade barriers and how much Canada stands to benefit from doing so. Now, we caught up with Trevor just before the First Minister's meeting Monday in Saskatoon. So obviously some news coming out of that and some of the MOUs between various provinces, including, of course, Alberta and Ontario. So we hope to see more of these announcements, more follow through as well. You know, it's one thing to make these announcements and it's another to actually do it. But we're seeing some encouraging moves in that direction. All right, still to come on the podcast, an interesting new study out looking at the relationship between Alberta and Ottawa and why we see so much Western alienation these days. This report makes the case that it's a byproduct of federal overreach, that we've got jurisdictional lanes, constitutional divisions of power, and Ottawa trampling over that provincial jurisdiction is a big component in why there's so much frustration in the West. So we're going to hear from one of the co-authors of this report, Sonya Savage, in fact, former Alberta Minister of Energy, also of the Environment, co-author of this report for the Macdonald-Laurier Institute. So we'll take a closer look at some of those issues coming up shortly here. My name is Rob Breakenridge. Stay with us. An important new report from the Macdonald-Laurier Institute. It's called Imbalance of Power, How Federal Overreach Fuels Western Alienation. You can read it for yourself, macdonaldlaurier.ca. I'm very pleased to be joined here by the report's co-author, Sonya Savage, as a senior fellow at the Macdonald-Laurier Institute, and of course, former Alberta Minister of both Energy and the Environment. Ms. Savage, so great to have you with us here. Welcome to the program.
Well, thank you for having me.
As I say, the timing is important and presumably deliberate on your part to highlight some of these issues, because what we're dealing with right now, right, this rise in discontent and frustration, how important is it that we get ahead of that?
Well, first, I want to acknowledge my co-author, Heather Exner-Perot. I enjoyed writing the paper with her, but when we started out with this paper, what we wanted to do is really be able to capture the growing sense of Western alienation that we're seeing fueled in the prairie provinces, Alberta and Saskatchewan in particular, over the last couple of months. And to demonstrate that it's more than just about getting a pipeline built. And I think some of the background on that is over the last number of years, every time Alberta's raised a grievance that Ottawa's interfering with our jurisdiction or Ottawa's holding us back, the number of times that I will get a response, or we would hear a response from Eastern Canada saying, well, they gave you a pipeline. What more do you want? So I really wanted to show that this is more than just getting a pipeline. These grievances are really deep rooted, and they go back over 120 years to the time when Alberta joined Confederation. It's more longstanding than the more current debate in the last 10 years, the last decade, that's been more centered around pipelines.
Right, because as you say, this goes back much further, and understanding sort of as the title of the report refers to, the balance of power in Canada, where there is clear provincial and federal jurisdiction, and kind of blurring those lines, or almost an erosion of that provincial jurisdiction, and that speaks to a lot of this, doesn't it?
Well, and it speaks to a long-held belief in the province that we've been treated unfairly, and that the balance of power is in Eastern Canada and not in the prairies. And that goes back to when Alberta joined, well, it goes back to the Confederation. When we first became a country in 1867, and the four eastern provinces that formed Confederation, all of those provinces were given ownership rights in mines and minerals and their natural resources, forestry, at that time. When Alberta joined Confederation in in 1905, Alberta was not given those same rights. Neither was Saskatchewan. It wasn't until 1930 that Alberta was granted the same ownership rights and resources as every other province had had since they joined Confederation. So it's deep-rooted, and those ownership rights weren't granted without a lot of political push from Alberta and a lot of grievances. So it goes way, way back, and it flares up from time to time. And we really wanted to show that in this report that some of these grievances are rooted in the Constitution, and the sense, especially in Alberta, that Ottawa doesn't follow the Constitution when it doesn't meet their political objectives. They'll trample upon our political rights, our ownership rights that have been fought for very hard.
Well, that's the thing. And I think there's a sense in Alberta that we really don't control our own destiny, or not as much as we need to, which speaks to maybe some of the mood right now. But, there is a shared interest as Canadians in shared destiny, I suppose you could say. But it does matter for provinces to have control and have responsibility in these areas. Why is that, in your view, so important?
Well, I think it was recognized when the country first formed that it's a pretty big country. It's diverse, it's broad, it's a huge land base, and each region is going to have different interests, different resources, different priorities. And so the Constitution, the balance of powers set out in Section 91 and Section 92, for constitutional geeks who are listening to this, the balance of power was set out in those sections of the Constitution to reflect large regional differences. And in Alberta and Saskatchewan's case, we have very often, particularly in the 1970s and again in the Trudeau decade, have felt that Ottawa hasn't upheld their side of the bargain, that they'll trample upon our jurisdiction and our rights if it gets in the way of their political agenda.
As you say, these issues go back decades, and they've flared from time to time. But it does feel, certainly over the last decade, we've seen a lot more of this, and we see it reflected in some of the court challenges where Alberta has been successful, and that's worth noting. But also, maybe some of the court challenges yet to come. There just seem to be a lot more of these issues more recently.
Well, absolutely, and I think we have to root it back again a bit in history to the 1970s, to the National Energy Program, where was the first time where Alberta felt aggrieved that their rights were being trampled. With Pierre Elliott Trudeau's National Energy Program, there were export tariffs on our oil and gas. There were price controls setting the price at which our products could be sold at, and there was a sense that Ottawa was prepared to take and transfer wealth from the West to the East in light of the OPEC embargo and rising prices for consumers in the East. So in that, there was a lot of acrimony, as much as what there is now. I mean, I was just little, I don't really remember it, but history will show that it was very similar to what we've experienced in the last decade. And at the end of that era, Peter Lougheed and Saskatchewan's Premier Alan Blakely negotiated an amendment to the Constitution, Section 92A, which really fortified the rights that the provinces had to ownership and development and management of their resources. So fast forward 40 years later, we feel that end of the bargain hasn't been upheld by Ottawa. And again, they're taking away and trampling those rights, not for reasons to expropriate wealth from the province, but to shut our resources in the ground and to ensure that their climate policy objectives are met. And to the extent that Alberta's constitutional rights to ownership of resources gets in the way of the climate objectives, they'll be subsumed and trampled.
There was one court case where Alberta almost in a way was on kind of a different side when BC tried to assert some provincial jurisdiction where it really didn't exist to block the Trans Mountain Pipeline. And I think for Albertans, we want to see that benefit where being part of a confederation, having a national government can be of some advantage. So that ended up being an interesting case. So where do we still need to see that assertion of jurisdiction by the federal government alongside respecting provincial jurisdiction?
Well, you're right. The federal government has jurisdiction over pipelines that cross provincial barriers or export pipelines. They have jurisdiction with regards to trade and commerce and exports international policy, foreign policy. So they do have jurisdiction when it comes to pipelines. And that's been a long held grievance for the province too, is Ottawa's exercise of that jurisdiction has made it impossible or very difficult for the province to exercise its authority in management and production of natural resources. So in the last decade, that's been particularly an issue, and probably nothing more demonstrated than the veto of Northern Gateway Pipeline.
There are areas where there's almost overlapping jurisdiction, or it's kind of a gray area. I know we've seen that with the Impact Assessment Act, where Alberta would say, well, this is within provincial boundaries or provincial jurisdiction, and the federal government says, it's fisheries or water or First Nations or other areas that are their jurisdiction. How do we resolve those kinds of disagreements? How do we adjudicate or share the jurisdiction in those cases?
Well, you're right. Environment has been considered a shared jurisdiction. There's elements of it that are federal jurisdiction. There's elements that are provincial jurisdiction. It wasn't part of the Constitution in 1867. There wasn't an enumerated head of who's responsible for the environment, so it's shared. And it's flared up over time and created some issues between the province and the federal government. Roots of it go back to the Old Man Dam decision, an early decision of the Supreme Court, and disagreements between the federal and provincial government on who has the right to do environmental assessments on projects. And the Supreme Court in that case said the federal government does have a right to assess projects, but it can't use that assessment to regulate things that are within provincial jurisdiction. And there's some clear learnings from that decision, and from the fast forward to the Supreme Court decision in Bill C-69. There's some clear decisions there on how the provinces and the federal government can work together and be able to achieve autonomy in their own areas of jurisdiction. And especially the Supreme Court pointed out to collaborative federalism. Basically, guys get together in a room, figure it out, and find a way forward. And that's where I think we have a real opportunity now that the Justin Trudeau decade is gone and we have a new prime minister who wants to get things built and says he wants to build nation-building projects. I think we have an opportunity to maybe achieve some of that.
Right, because we're on the cusp here of fights that maybe we could avoid if there's a different approach. I mean, one of them is the emissions cap on oil and gas, and Alberta arguing that, look, that really cuts into the production side, which is our jurisdiction. And there's the clean electricity regulations, which seems much more clear that electricity is provincial jurisdiction. So we're sort of on the cusp of going through all of this again in the courts, but
you're 100% right.
At least ideally, right?
And I'm most certain that those regulations would be found unconstitutional in the courts. If the Impact Assessment Act was found unconstitutional because it assesses projects that are in provincial jurisdiction, the clean electricity regs and the emissions cap would actually be regulating production of oil and gas and regulating production of electricity, which are deemed in the exclusive constitutional jurisdiction of Alberta under 92A. So I think it would be a very difficult case for the federal government to make constitutionally. So we could spend the next 5 years fighting about it in the courts, spending a lot of taxpayer dollars litigating it. In the end, will likely be found unconstitutional, or we can find a better way and find a way for the province and the federal government to work together to understand that the federal government has some climate objectives, which Alberta should and could be helping the federal government meet, and understanding that the province has some production objectives to increase production, increase royalties, create jobs that the federal government needs to respect. And I think we hopefully we're entering an era where we can bridge that gap.
Yeah, because I mean, at least in theory, it's straightforward enough. It's not like we have to change the Constitution or anything crazy like that. Like there's some reachable, or even dare I say, simple solutions here.
Yeah, we just have to follow the Constitution. It's there for us. It's not an option to follow the Constitution. It's mandatory. And if you don't, the courts will strike down what you're doing. The sense in Alberta to pour fuel on the fire is that Ottawa now just dismisses what the courts say about the Constitution. The Supreme Court found the Impact Assessment Act to violate the Constitution, and instead of striking it down and saying the law is not enforced in effect, it gave the federal government the opportunity to fix it, set out some general guidelines of what was wrong with the legislation for the federal government to fix it. What they came back with was very, some vague words. They added some words. It really didn't fix it. It just really did not solve it. So in Alberta, that poured fuel to the fire, that even when the courts say something Ottawa is doing is unconstitutional, Ottawa will find a way to do it anyways. Those days hopefully are in the past, and we can move on from them and move forward.
Well, let's hope so. This report offers a roadmap in that direction. Very timely and important, as mentioned, imbalance of power, how federal overreach fuels Western alienation. Much more at MacDonaldLaurier.ca. Sonya Savage, thanks again for making some time for us here. Really appreciate this.
Thank you.
And once again, that's Sonya Savage, former Alberta Energy Minister, a senior fellow at the Macdonald-Laurier Institute. Again, you can read that report at MacDonaldLaurier.ca. More of the Rob Breakenridge Show still to come. We're back with more right after this. Welcome back. As we've been discussing, the First Ministers met in Saskatoon on Monday, and certainly pipelines have been a big part of that conversation. Really, certainly Alberta's Premier wants to make sure that these are a big part of the conversation moving forward, that this is a top priority for the Prime Minister. An interesting clip here from Alberta Premier Danielle Smith speaking with reporters on Monday afternoon, talking about why we need more pipelines, more pipeline projects. And specifically, she was asked, why link pipeline projects to the whole issue of national unity? And here's what she had to say.
Well, you have to understand just how damaged Alberta is by the fact that we didn't get pipelines built. If we had built Northern Gateway, if we'd built Keystone and we'd built Energy East, we'd have 2.5 million barrels more per day of production, which is $55 billion a year worth of GDP value, which is worth $17 billion to my government alone and about an equal amount to the federal government. So this is not just an ideological argument. It's not just a minor disagreement. Oil is by far the most valuable export for Canada. Any of the projects that you will see on the ultimate list, I will tell you that a bitumen pipeline will be by far the greatest benefit to all of Canada. That's why we're going to continue to push for it, because it's a good project. It's good for our country. There's $9 trillion worth of value in discoverable and achievable reserves right now. And so why would you leave that in the ground? No other country in the world would, and we shouldn't either.
Okay, so some interesting comments from Alberta's Premier. Look, I think there's no doubt if we had more pipeline capacity, that would lead to more production. In a weird way, this almost kind of validates one of the criticisms that pipeline opponents have made, that when you build more pipelines, that leads to more production. I think oftentimes in the past, defenders of pipeline projects have said, well, really, it's just about the best way of moving that product, that the production is going to meet the demand regardless. It's just a case of whether you move it by pipeline or maybe you move it by rail, for example. But this does kind of concede the point. Yes, if we had more pipeline capacity, we could and would increase production, especially if you're in a situation where you're near the limit of that capacity. Now, we're not in that position right now. The Trans Mountain Pipeline expansion has been crucial in allowing us to have that additional capacity, as well as give us another export destination other than the U.S. So when the Premier says, yeah, if we built Northern Gateway, Keystone XL, and Energy East, we'd have more pipeline capacity, which I guess is true. Would all of this had happened altogether? I mean, would TC Energy, for example, have built both Keystone XL and Energy East? It was the same company behind both. Kind of seemed like they preferred Keystone over Energy East. Would they have built both? If Northern Gateway had gone ahead, what would that have meant for the Trans Mountain Pipeline expansion? And so, no, I mean, I don't know if it's fair for the Premier to say we haven't built any pipelines. We did build the Trans Mountain expansion. There was also the Line 3 expansion as well. And those were important pieces of pipeline infrastructure. But she's right to say that we could use more, and we will need more in the years ahead. Now, there's a lot of other factors at play here, of course. There is supply and demand. There's also oil prices. What kind of investments are we going to see in production? That's also going to depend on prices. That's going to have an impact on demand. So there's a lot of other factors at play here. And we're in an interesting moment where oil prices have sagged a bit. It's to the point where, I think Alberta's worried about bigger deficits, et cetera. It's maybe that's still in that realm where, it's profitable for Alberta oil sands producers, maybe not quite at the point where everybody's comfortable making huge capital expenditures. So a lot of questions about where things are going with oil prices at a time where now OPEC countries are prepared to actually increase production. At a time when you got a U.S. president who wants to increase production, but also wants lower prices at the same time. Donald Trump imposing tariffs that could have an impact on Canada's production or our ability to build these pipelines. So there's a lot going on. Joining us for some further analysis of what's happening with oil prices, oil production, oil pipelines, very pleased to welcome to the program Rory Johnston, a Toronto-based oil market researcher. He's founder of Commodity Context, a great resource, commoditycontext.com. He's also host of the podcast Oil Ground Up. Rory, it's so great to have you with us here. Welcome to the program.
Thanks for having me, Robin. Congrats on the new program.
Well, I appreciate that. Appreciate you making some time for us. Always do enjoy your insights on all of this. Let me just ask you, and it's a fluid situation with what's going on with wildfires right now, but there was an announcement from Cenovus that they're shutting in some production. We could see other similar announcements, and it's tough to track in real time, but just overall, big picture, what kind of an impact could this have, first of all?
So what we're seeing so far, you're absolutely right. The largest confirmed closure has been Cenovus's Christina Lake facility, which was confirmed this morning. That's a roughly just shy of 250,000 barrels a day of in situ oil sands production. So a very, very large project, very large chunk taken offline. At this stage, what I'm tracking is currently around, give it 250 to 300,000 barrels a day of production currently offline, say 8%, give or take, of Canadian oil production. That is a pretty sizable hit to North American balances in particular. And what we've seen over the weekend is that despite the weekend kind of being defined in oil market intrigue by OPEC's meeting, where you saw an increase, another announced increase in production, we actually gapped up on Monday morning as, both, I think, a combination of the hike was not quite as large as some were fearing, but also these wildfire developments continued to kind of grind forward. And right now we have probably upwards of 500,000 barrels a day of production currently at risk. Obviously, Cenovus's Christina Lake facility is right next door to MEG's Christina Lake facility and a bunch of other major in situ assets in the region. I think that's a big reason why the overall oil market, despite the OPEC intrigue, is looking pretty tight. And I think particularly for North American and WTI balances, everything's looking very, very tight right now.
Yeah, it's interesting you mentioned. So we see oil prices up slightly in early trading on Monday, despite the fact that OPEC has announced this production increase. So part of that is everything else going on. Part of it is we've kind of been expecting it. But why isn't that having more of an impact, pushing prices down?
So it's honestly the $1 trillion question in the oil market right now. And what's fascinating about it is, so for those that aren't aware, the 30-second background of what's happening is OPEC has held a tremendous amount of oil off the market now for a couple of years, trying to support the price higher. But after many, many years and an inability to get prices back towards those triple digit levels that we saw in 2022, essentially they've begun unwinding it. So the current discussion and what we're currently talking about is roughly 2.5 million barrels, or roughly 2.5% of global supply, that's being unwound by the so-called subgroup of 8. So this is Saudi Arabia, Russia, UAE, et cetera, the biggest kind of core players within OPEC Plus. And they're unwinding 2.5 million barrels a day of production. The initial plan was that would take place over 18 months, so very gradual. And when you finally saw it start in April, it started as planned. But then May, you saw a tripling of those production increases versus plan, a same tripling in June. And now over this past weekend, we saw another, rather than the kind of 137 that they were promising initially, more like 411. So that's a lot of oil. And now at this stage, it looks like the entire 2.5 million could be returned to the market by the end of the year. That is, on its face, on paper, extremely bearish. It should be extremely price negative. But you're right. So far, what we've seen is that the prices, while they have sold off alongside this acceleration of production increases and the announcement of Trump's reciprocal tariffs on Liberation Day, now what feels like eons ago since everything's moving around so quickly. But all of that's come off the market. But during that period, the actual term structure of the market, inventories, all the signals that we'd really look to confirm a weakening of the market have remained strong. Markets have remained tight. I was mentioning the oil sands and Alberta wildfires are further exacerbating that. But overall, the realized market impact has been notably smaller than what it should be on paper. And there's a couple of theories as to what's going on. One is that a lot of the production increase that has been promised has actually already hit the market because of kind of wide-scale cheating within the producer group, even that core group of 8. But even factoring for all that, we should see more Saudi production in particular coming back to the market. Theoretically, they've already increased their quota by about 500,000 barrels a day. So they weren't cheating. They were roughly in line. So where is their oil? And what we're seeing right now is it's not coming to market as we'd expect. So the most bullish read on this is that despite kind of talking about easing the market and kind of this bearish rhetoric, they're maintaining a tighter, more cautious and conservative hold on the actual physical oil market. And that's why we haven't seen it yet. So I think it's still a massive debate amongst analysts like myself as to what exactly they're up to. And if we're going to see this oil maybe later in the fall after summer power consumption dies down in the kingdom. But again, it's the single biggest question in the market right now is how much actual new OPEC oil we're going to get between now and say November.
Yeah, that's interesting. So in the meantime, we're sort of stuck in this realm where prices are kind of okay. I mean, from Alberta's bottom line perspective, it's a bit of a hit, but for the sector itself, there's still the opportunity to profit. There's still some incentive for investments. And I guess maybe that's helped by what's going on with the Trans Mountain Pipeline and a boost in Western Canadian Select prices. So what does it all mean then for what's become, I think, a more resilient Canadian oil sector right now?
I mean, you're absolutely right. I think the combination of the startup of TMX, the overall continued tightness of global heavy markets, heavy crude markets in particular, when you're looking at, for instance, the price differential of WCS, not in Hardisty, Alberta, which is the market we normally talk about, but in Houston, that price is sitting around $2 to $3 a barrel, which itself is very, very strong. So even outside of pipeline politics, which are fine right now, which I think is a unique situation, and we've talked for probably almost a decade, and I think this is one of the happier moments in the industry in terms of a health position. WCS differentials in Hardisty today, that as I'm looking at them right now, are about $8.50 a barrel. That's excruciatingly strong in the scheme of things. So even if oil prices on a global level have weakened, I think notably over the past couple of months, we've been insulated from a lot of that from this tighter differential, as well as the kind of continued relative weakness of the Canadian dollar. All that together means that you have had stronger netbacks to Canadian oil sands producers, conventional producers across the board. The only real offset to that is that we have also seen a lot of those producers shift into their post-payout royalty regimes. So even if they aren't even if some of that has been blunted in terms of the money that they're making and what they're able to yield back to investors, all of that upside is still going to the Canadian public in terms of royalties, in terms of income tax rates, et cetera. So it's been a really strong moment for the Canadian oil industry's contribution to the Alberta economy in particular, but I think the Canadian economy more broadly as well.
On the U.S. side of things, shale production in the U.S. may be a little more vulnerable to everything going on right now. You got a president who, I don't know, I guess he wants higher production but lower prices. He's got these tariffs, especially now steel and aluminum. That could impact production costs. That could certainly impact the cost of building new pipeline infrastructure. What's the Trump factor here, do you think? Yeah,
so I think Trump's desire for both drill, baby drill, and notably lower pump prices is at its core incompatible. And I think they'll pretend to kind of talk around that, and they're going to cut production costs and deregulation with the new Secretary of Energy and the new Secretary of the Interior. But at the end of the day, we're talking about maybe a couple dollars a barrel saved in operational costs and regulatory burden. But that doesn't really make up for the fact that we're down kind of $15 a barrel from Trump's inauguration or more. So No, I think what we've seen is that U.S. crude production growth has slowed markedly over the past couple of years, even before Trump came into office and kind of tanked the global oil market. What we did see in the latest monthly data, this is the accurate data from the Energy Information Administration in the U.S. Department of Energy for March. So this is a little bit lagged now, but we did see a little bit more strength than we had expected in February and March. So what we had seen as a near flatlining in February was back revised to a slightly stronger balance, but most of the real price pain and tariff pain and everything else only started in April. So that is when, and all kind of higher frequency indications indicate that, activity and investment, intention in the U.S. shale patch has essentially evaporated over that period. We've seen nearly 30 oil-directed rigs cut over that period. These are not the signs that you would want to see if you wanted to see a kind of a reacceleration, even a kind of a flatlining of U.S. crude production. So, while you see a lot of crude production elsewhere, I think Canada still is going very strong. These price declines are going to hit the U.S. fastest. And then you also mentioned things like the steel tariffs, upwards of 10 to 20% of the production cost of any given oil well. And it's not just in pipelines. You have, if you have, you dig down, you drill down vertically, and then you drill out potentially upwards of 2 miles horizontally. You need production casing, steel pipe for that entire kind of journey. That's a lot of pipe. We're talking hundreds of tons of pipe or hundreds of tons of steel per well. That is, if you increase this by 25% initially, and now as of late last week, you're talking about 50% across the board steel tariffs. This is a direct cost increase to the U.S. shale patch. The one offset that we have seen in terms of steel pricing, I was chatting the other week with a dealer in kind of what they call the oil country tubular goods, which is essentially their acronym for steel pipe. They're saying that while the steel pricing is increasing, the supply at those prices is withering up because of the tariffs. You have also seen a pretty marked pullback over the last 2 months in activity and demand for the pipe. So going back to the previous point about how overall, these prices just aren't stimulative enough for U.S. production.
Well, we talked about TMX and the impact and what it's meant for Western Canadian select oil prices. You wrote about this recently, a piece for the Macdonald-Laurier Institute, and it's an interesting question because we're not at a pipeline capacity crunch at the moment. So we certainly were in one pre-TMX, and there's kind of that question now with all this talk about possible new pipelines. Do we need it? When are we going to need it? What's your sense of where we're at in terms of our capacity challenges in the short and longer term here?
Yeah, I would say one of the funny things, and particularly mentioned that piece I published with the Macdonald-Laurier Institute, which is very thankful for them publishing those views. But you actually saw there was an environmental group that actually cited that piece as an example of why we don't need new oil pipelines. And it was such a frustrating read because, yes, at this exact moment, we currently have enough pipeline capacity. But that is one of the, as I was just saying earlier, one of the only moments over the past 15 years where that's actually been true. We have been chronically short for more than a decade. And, with TMX coming online, it was the largest single addition to egress, essentially since I've joined this market. We're going to eat through that very, very quickly. Canada is still one of the fastest growing sources of oil production growth in the world, even with prices where they are right now. That will probably slow if these pricing levels continue. But the oil sands compared to the U.S. shale patch are far slower moving. So it takes a lot longer for that slowdown to happen. It's like turning an aircraft carrier versus like a fighter jet in the United States. I think that inevitably we're going to need more pipeline capacity in another year or two at the most. So it's very frustrating to see finally we have a healthy market and then people are using that as an excuse for why we should never build another pipeline. It's the exact opposite. Rather than that being an argument for we don't need new pipeline capacity, it was in its core kind of a strong argument for the value of pipeline capacity expansions, because that's the only reason why we weren't also facing an egress crisis on top, or pipeline capacity crisis on top of a U.S. tariff crisis at the same time.
Well, yeah, I mean, then maybe there's room to expand TMX further. I guess there's the question of what are the more doable or achievable or quicker projects versus the much longer timelines of a big new pipeline project, right?
Yeah, so I think there's a couple things already on the table. I think in terms of what we already know and has already been committed to, you've seen further committed expansions of Enbridge's mainline, which is the primary conduit of oil out of Western Canada. But that the challenge there is that, one, we had seen kind of pledges to increase capacity prior. We saw them in the mid-2010s, and they still didn't make up for, they didn't arrive in time for the capacity crunch in 2017 and 2018 when you actually saw forced curtailment to kind of balance the Western Canadian oil egress system. So I would say that is hopeful. But again, it also doesn't help with diversification away from U.S. markets, which has been increasingly popular amongst the Canadian public following the tariff brouhaha and a stated priority of the new Carney federal government as well. So in terms of where you could see that, a lot of people are pushing for like a revitalization or kind of a reincarnation of Northern Gateway to the West Coast or Energy East to the East Coast. That is obviously a very heavy kind of lift. Given the politics and the kind of difficulties there. Much lower hanging fruit is that the federal government still owns the Trans Mountain Pipeline system, and you could further expand TMX compared to what we've already done. And I've seen pretty compelling kind of estimates that you could probably increase in the nearest term by another 200,000 barrels a day. The pipeline overall has somewhere in the ballpark of just shy of 900,000 barrels a day of capacity. Between the legacy and expanded pipelines. So you get another 200 with what they call drag reducing agents that essentially reduces the friction in the pipe. So you can increase the amount you're pumping through at any given pressure. And then you can further increase by another 200,000 barrels a day by adding additional pumping stations along the route, which essentially also just helps boost pressure. Basically just trying to picture how much, soda you can push through a straw. If you blow harder, you can fit more through. So I think that's the argument here is that you could expand. So if the federal government and the Carney cabinet is serious about trying to use every tool at their disposal to both increase and help the Western Canadian oil patch and diversify further away from the United States, that is something that I could see happening. And you've even seen the Trans Mountain Corp CEO recently mentioned that there could be scope for that company to take on additional projects as well. Although, as a standard practice, they would prefer to see the private sector kind of take the lead on these projects.
Indeed. Well, we'll see if we get a clear picture on any of that this week. In the meantime, much more on all of this, commoditycontext.com. Rory Johnston, again, appreciate the insight. Thanks for joining us here.
Thanks for having me, Rob.
Okay, once again, that's Rory Johnston, Toronto-based oil market researcher, founder of Commodity Context, commoditycontext.com. Also check out his podcast, Oil Ground Up. We're back to wrap up this edition of the Rob Breakenridge Show right after this. Hey, welcome back. Our thanks once again to our guests on this episode, Trevor Tombe, Sonya Savage, Rory Johnston. I do want to let you know, coming up on our next podcast, which will drop for you on Friday, we're going to be joined by Dr. Brian Day. He's got a new book out this week. It's called My Fight for Canadian Healthcare, a 30-year battle to put patients first. And he has been right in the thick of it when it comes to the fight over how we deliver healthcare in Canada, cases that have gone all the way to the Supreme Court of Canada. But Dr. Day has made the case for health reform, a model that would put patients first and get people away from the waiting list that we face in our system. So he's laid all of that out in a new book, which is mentioned is out this week, and we will have that conversation with Dr. Brian Day coming up on the next episode of the Rob Breakenridge Show. Don't forget, you can find us at robbreakenridge.ca. We are available on your podcast platforms like Spotify, like Amazon Music, and yes, now Apple Podcasts. That was a bit of an ordeal, but we are now there on Apple Podcasts. So you can listen there, subscribe there, and of course, as mentioned, robbreakenridge.ca. Also, our YouTube channel as well, Rob Breakenridge Show. Check us out there. We got the audio of full episodes as well as video of some of our individual interviews. So you can find our YouTube channel, but all of it again at robbreakenridge.ca. Thanks for being with us on this episode of the podcast. We will talk to you later this week.